Most individuals believe cash reserves are completely secure inside a high-yield savings account. In reality, persistent inflation is quietly erasing real purchasing power as this analysis is spoken. In the macroeconomic climate of 2026, traditional saving paradigms are collapsing. Those who choose to remain passive are actively losing wealth every single day. This analysis outlines the 7 defensive maneuvers that must be executed immediately to secure capital before the next major market realignment. The macroeconomic landscape of 2026 has exposed the profound vulnerability of capital passivity. Following the transition of central bank leadership to Kevin Warsh in June 2026, the Federal Reserve has maintained the federal funds target rate in the highly restrictive range of 3.50% to 3.75%. Despite this sustained monetary tightening, inflation has demonstrated extreme persistence, driven by severe supply shocks and geopolitical conflict in the Middle East. The Bureau of Labor Statistics reported that the annualized consumer price index reached a 3-year high of 4.25% in May 2026. This inflationary pressure is highly concentrated in crucial energy inputs. Year-over-year energy price inflation has skyrocketed by 23.54%, with gasoline surging by 40.5% and fuel oil expanding by a massive 58.9%. These rising input costs are feeding directly into downstream consumer prices, creating a structural stagflationary environment that cannot be resolved through conventional cash preservation. The danger of a passive wait-and-see approach is further highlighted by the systematic contraction of real wages. In May 2026, real average weekly earnings declined by 0.15% month-over-month, representing a cumulative 1.74 percentage point reduction year-over-year. This means that while nominal assets may appear stable, the underlying purchasing power is experiencing an invisible tax. Fiduciaries at firms like Goldman Sachs and J.P. Morgan have pushed rate cut expectations out to late 2027, with some predicting that the Fed may be forced to hike rates further if energy pressures continue to spill over into services. Furthermore, research from the Peterson Institute for International Economics warns that the lagged pass-through of tariffs, combined with a projected $1.9 trillion federal budget deficit, could push headline inflation well above 4.5% by the end of 2026. Dormant capital is no longer safe. It is actively decomposing. To protect net worth from currency debasement, capital must transition away from paper assets toward high-quality hard assets that possess intrinsic demand and collateral-based cash flows. According to global asset manager KKR, the global economy is shifting from a low-cost, efficiency-first model to one that prioritizes redundancy, supply chain autonomy, and physical security. This structural megatrend, the security of everything is driving immense institutional capital into power and energy infrastructure. Unlike past economic cycles where electricity demand was driven by single factors, 2026 is experiencing a multi-secular convergence. Artificial intelligence infrastructure, massive data center construction, reshoring of manufacturing, and widespread electrification are occurring simultaneously. At the same time, the supply side is severely constrained by grid complexity, permitting delays and prolonged equipment lead times. Real assets linked to nominal GDP, specifically power infrastructure and logistics bottlenecks, provide robust inflation protection and portfolio durability. International real estate has emerged as another essential component of this hard asset shift. Forward-thinking investors are diversifying globally to mitigate currency Concentration risk and access. Superior demographic tailwinds in 2026. Prime functional real estate in jurisdictions like Dubai, Thailand, and Turkey provides a double hedge. The underlying property value adjusts to rising material and construction costs, while professional, full-cycle rental management delivers cash flow that naturally adapts to local cost of living increases. This reallocation is critical because traditional high-yield corporate debt is experiencing severe structural failures. Years of aggressive corporate underwriting have created a massive credit loss cycle in 2026. Elevated interest rates have put immense pressure on middle-market companies. Roughly 12% of private credit corporate borrowers now operate with negative cash flow, and 13% have interest coverage ratios below 1.0. The growing reliance on payment in kind, PIK, interest, where companies pay debt with more debt, is compounding leverage and raising default risks. Investors must avoid overleveraged corporate credit and focus instead on asset-backed finance, where yields are supported by high-quality physical collateral. The persistent inflationary pressures of 2026 have also rendered the traditional equity defensive playbook obsolete. Conventional wisdom suggests buying energy stocks and consumer staples to combat rising prices. However, wealth fiduciaries like J.P. Morgan warn that the energy sector has rallied past sustainable valuations, leaving it highly vulnerable to sharp earnings downgrades if geopolitical tensions ease and oil prices correct toward long-term averages. At the same time, the consumer staples sector is facing severe margin degradation due to elevated manufacturing input costs, which rose 4.6% in late 2025, and sticky labor costs, combined with a clear loss of pricing power as consumers become highly value conscious. Instead, capital is rotating into a quieter and more resilient defensive playbook, prioritizing healthcare and utilities. Healthcare. This sector is structurally insulated from energy price shocks and economic cycles, driven by inelastic demographic demands from an aging population. High-quality healthcare firms exhibit robust pricing power and strong innovation pipelines. The sector's projected 2027 year-over-year earnings per share growth rate stands at approximately 14%, compared to its historical baseline of 9%. Utilities, benefiting from the massive electrification wave. Utilities offer stable cash flows supported by regulated rates. They possess unique operational flexibility, allowing them to substitute cheaper natural gas for oil when fossil fuel prices spike. The sector's estimated 2027 earnings growth is projected at 9%, a dramatic increase from its long-term average of 2%. To further shield equities from a volatile domestic dollar, defensive strategies are incorporating value-oriented international markets. Latin America, specifically the MSCI Emerging Markets Latin America Index, represents a premier allocation opportunity. The region enjoys strong macroeconomic fundamentals, including energy independence, nearshoring advantages, and fiscal consolidation. Following the geopolitical escalation in early 2026, sentiment-driven risk discounts dragged the Latin American index down by over 12%, leaving it trading at a forward P/E of just 10.2. This represents a massive 51% discount to broader emerging markets, the widest valuation gap observed in 20 years, providing an exceptional cushion for defensive capital. A comprehensive wealth protection strategy must include alternative stores of value that remain completely uncorrelated with standard equity and debt markets. This structural diversification has reignited the intense debate surrounding physical gold versus digital assets. Over the 12-month period ending in June 2026, the performance gap between these two assets widened dramatically, delivering a clear signal to capital allocators. while the S&P 500 posted solid gains of 27%. Spot gold emerged as the supreme safe haven asset, advancing 33.1% over the past year. This performance was supported by strong structural buying from central banks, looking to diversify official reserves away from fiat currencies, and a massive surge in demand from Chinese net imports, which tripled to 317 tons in the first quarter of 2026. Despite a temporary 10% seasonal pullback in early June, J.P. Morgan Global Research projects gold to average $6,000 per ounce by the final quarter of 2026, rising towards $6,300 in 2027. In stark contrast, Bitcoin declined by 38.5% over the same 12-month period. Although long-term whale accumulation continues to support the asset during major dips, Bitcoin's high correlation with speculative technology stocks makes it highly sensitive to equity market sell-offs. For immediate capital preservation, physical gold has proven to be the far more reliable safe haven. Simultaneously, institutional capital is utilizing Treasury inflation-protected securities, TIPS, as a mathematical floor for conservative portfolios, with 10-year TIPS offering a guaranteed real yield of 2.2%. Above inflation, investors can lock in positive, risk-free returns that completely outpace the real-world erosion of cash. For high-net-worth portfolios, fine art and luxury collectibles have also completed their integration into mainstream finance. Under the transvertical shift, the barriers separating fine art, luxury timepieces, and digital assets have collapsed into a single, fluid asset class evaluated primarily on liquidity velocity, the ease with which an asset can cross borders and resist tariffs. The U.S. art market rebounded by 23.1% in late 2025, driven by estate sales over $10 million and a surge in financial guarantees, which reached 78.3% in New York evening sales. This confirms that high-income households are aggressively shifting cash into high-value physical masterpieces as a secure store of wealth. The final, and perhaps most critical, pillar of this defensive strategy requires a systematic operational framework to optimize liquidity and restructure liabilities in a high-interest rate environment. Average American households are carrying historic credit card balances, burdened by compounding interest rates that make debt exceptionally difficult to shrink. Investors must immediately list all outstanding liabilities, their respective interest rates, and amortization schedules, because high-interest debt compounds daily. Leaving liabilities unmanaged will rapidly wipe out any investment gains. Portfolios must prioritize high-interest debt reduction using the mathematically optimal avalanche method, allocating surplus cash flow to crush the highest APR balances first while maintaining minimum payments on the rest. For outstanding revolving credit balances, utilizing structured personal debt consolidation loans or 0% APR balance transfers can effectively freeze compounding interest, creating a predictable, fixed-term amortization path to debt freedom. Maintaining immediate liquidity is essential to avoid the forced premature sale of long-term assets during market downturns. However, standard checking and savings accounts act as a slow-burn tax on capital, with national average interest rates lagging far below inflation. Surplus liquidity should be moved into short-term, high-yield cash equivalents. Utilizing ultra-short duration government treasury bond ETFs, such as SGOV or BIL, allows investors to capture a 3.5% annualized yield with near-zero price volatility, protecting cash reserves from inflation while keeping them completely liquid for emergencies. To ensure that an investor's total net worth is growing in real terms, nominal returns must be audited against the localized rate of inflation. This is calculated by applying the Fisher equation, which defines the relationship between nominal interest rates Real interest rate adjustments and inflation. Under the current macroeconomic conditions of 2026, where the annualized CPIU benchmark sits at 4.25%, any asset allocation yielding a nominal return of 4.25% or less is generating a negative real return. Even top-tier high-yield savings accounts offering 4.1% fail this mathematical test, resulting in a real wealth contraction. Executing a quarterly audit using this mathematical filter allows investors to systematically reallocate capital away from negative yielding cash and overextended equity sectors into the positive real yielding defensive positions outlined in this report.